Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it was a busy day for economic data. We got GDP numbers, we got durable goods, we got inflation data, jobless claims, and new home sales. All happening on Thursday. And all kind of interconnected to some extent, which would make sense, showing the data is in fact real. But welcome everyone to the Friday edition, my favorite edition of Wilmington Mortgage, the final show of the week, which is awesome because it's only the second one of the week. Short week here, Wilmington Mortgage. But I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I'm sick, on vacation, or it is the Azalea Festival weekend. It's neither of those, so here we are. So, yeah, a lot of data, a lot to get to. Trying to figure out what's important, what's not, who's interpreting what, who's doing that. So it's a lot. So it was a good day for rates. We had the 10-year was down about 2 basis points. Now at the lowest level, 4.45%, lowest level since May 11th. And then Mortgage News Daily had the 30-year fixed rate at 6.59%. That was down 2 basis points. And that's the lowest level since May 14th. So just slowly making our way back down the mountain. I'm happy with the progress. Wouldn't mind a little faster, but I will take it nonetheless after the last couple of weeks. So let's jump into it. Obviously, the big report is the inflation report because it's an important reminder that the Fed has a dual mandate: unemployment or labor market and inflation. Bondholders care about one thing and one thing only, and that is inflation. And so while the labor market can have an influence on the Fed, it very rarely impacts the bond markets. And remember, the bond markets are what control mortgage rates. Now, that being said, a weak labor market can have an impact on mortgage rates, but it's really about inflation. That is the name of the game when it comes to mortgage rates. What is happening with inflation? If bond investors believe that inflation is going to rise, they're going to need more yield, for their money, and therefore you're going to see rates go up. They're going to sell current bonds, buy higher priced bonds, or I should say lower priced bonds, to get more yield. And so when it comes to inflation, when it comes to mortgage rates, it's all about inflation. And so we got an inflation report, and it's always important, it's always good to remind everyone that PCE from the Bureau of Economic Analysis is the Fed's preferred inflation gauge. They watch CPI, but they love PCE. And so this report has even more value. So the data from the Bureau of Economic Analysis showed that consumer prices rose 0.4% in April, which was down from the 0.7% rise that we saw in March, and was slightly better than economists were expecting. They were expecting a 0.5% rise. So if you see those numbers, you're like, oh, it was better than expected. The downside is the annual inflation rate rose to 3.8%. That is exactly what economists were expecting. That was up from 3.5% in March and is the highest reading since May 2023. Not a time like mid to late 2022, early 23 is not an inflation comparison that you want to be having to make. So not a good sign. This is, of course, Kevin Warsh's first official week as Fed chair. I'm sure he wasn't. Everyone saw it coming, which is why you didn't see rates rise, because they were like, yeah, this is what's going to happen. Doesn't mean it's good, but it's sort of baked in the cake. So that's why you didn't see a jump in rates. Besides inflation, we also got, of course, income, and personal spending. Not the best data. So personal income was flat in April, which was the second time in the last 3 months that we've seen no income growth. That's not good. Economists were expecting a 0.5% rise. They were expecting a little bump in income, and it did not happen. I was just thinking I didn't bring any water. I'm getting a little parched. It was a busy day, a lot of talking, and I don't have any water. When I was on the radio, I used to say that was like working without a net. Because in case you get like a tickle on your throat and you're on the air live, you need to have the water to take care of it. So it's like a tightrope walker not having a net underneath. But we're gonna push on. We're gonna persevere. We're gonna get through it. So I apologize if I'm like Marco Rubio at the State of the Union in 2015. Was it? I think it was 2015. 2013. Remember he did the what was it? Like the Spanish version of the response to the State of the Union. And then he did the State of the Union in English. That was the bigger broadcast. And it was live. And he like started getting, whatever you call it, parched. And so he had to reach and get the little bottle of water. I remember those things. So if it gets any worse, we'll deal with it. We might cut and go somewhere else. All right, so income was flat. Spending, though, jumped 0.5%, which is actually slightly above the rate of inflation. So you actually did see an increase in spending. But with income flat, where's that money coming from? We're going to get to that. So this was following a strong 1% jump in March. So spending is continuing to rise. And this was the third strongest monthly spending gain in the past 8 months. So like I said, where was this money coming from? Personal savings rate fell to 2.6% in April, a drop from 3.2% in March, and the lowest savings rate since June 2022, which I think could be the lowest on record. The June 2022 one. So, not great. Obviously, that's being interpreted as that people are keeping up with higher prices by not saving as much or pulling money out of savings. So that's it's kind of weird because if you're looking at it from like the Fed chair's perspective, or even if you're a bond investor, you kind of like to see the no income rise because it means, that's why they always say the cure to higher prices is higher prices. Because if consumers don't have the money, so if we're not increasing money supply, which means incomes are not rising, but prices are rising, people are just going to pull back on their spending. So they might not buy one thing, or they might get less of another thing, but they're going to keep their spending level, which is then going to force, people are going to go, oh man, my sales are down. We got to find a way to get sales back. So we're going to, maybe cut revenues by lowering prices or something along those lines. And so the Fed might be looking at that going, oh, okay, all right, so we're not seeing incomes rise 2 times in the last 3 months, and people are maybe being able to keep up with the spending by going into their savings, but you can only do that for so long. So they could be like, all right, we're on the cusp of a sort of deflationary move. Maybe, we will see. But there's a lot of ways to interpret it. People making a big deal about the savings rate, no rise in income, jump in personal spending, prices up, obviously, 3-year high in April. Not a great report, but not the end of the world at the same time. So that report came out. All of these reports came out, except for new home sales. They all came out at 8:30. So it was a very busy 8:30. I didn't get time to write about all of them, so I had to kind of do it throughout the morning and then the afternoon. U.S. economy grew more slowly in the first quarter than originally estimated. This according to, once again, the Bureau of Economic Analysis. They showed real GDP increased at an annualized rate of 1.6% in the first quarter of this year. That was revised downward from 2% that we saw in the first estimate. So we get the first estimate, we get the second estimate, then there's a third estimate. So right now we're on the second. So what changed? The 0.4 percentage point downgrade was primarily driven by weaker investment and softer consumer spending. Once again, going back to our earlier report of there being an issue, potential issue with consumer spending Even with the revision, though, the economy still expanded at a much faster pace than the 0.5% growth that we saw in the fourth quarter of 2025. Exports, investment, consumer spending, and government spending all contributed to the positive first quarter. Now, compared to late 2025, the acceleration in growth was largely driven by stronger government spending, improving exports, and faster investment growth. Consumer spending slowed and imports increased. I don't have time to get into this, but there's like this weird way that they calculate imports and make it look like they're negatives when they're not actually negatives, but we'll save that debate for another day. So we're seeing, still strong first quarter, downgraded a little bit, but like I said, still strong. Inflation report that once again wasn't great. I mean, it was bad, but it wasn't horrible. So we have those two reports. Then we got durable goods orders, which is always important, looking at what's happening in the manufacturing sector. And this was strong. This is a very strong report. U.S. manufacturing activity showed surprising strength in April. This according to the U.S. Census Bureau, as new orders for manufacturer durable goods jumped 7.9%, so basically 8%. This was up sharply from the 1.3% increase that we saw in March and was the strongest monthly gain since May 2025, so almost a full year. So pretty strong. Economists were expecting a smaller, almost 3.5% increase. So beating economists' expectations, this was a pretty good report. The strength wasn't limited. Some people might be thinking, this is all defense-oriented. It's not. When you exclude defense, durable goods orders rose 8.1%. So no, at all. That was after a 0.3% dip that we saw in March. That was the strongest reading for durable goods minus defense since May 2025. The other major category is durable goods excluding transportation, which is one of the most volatile components of the report, saw orders increasing 1.1%, which was exactly the same gain that we saw in March and was the third highest reading this past year. So a pretty strong durable goods order report. So, I mean, they're all kind of interconnected. So we got, once again, we have an inflation report showing inflation rising, which is usually what happens when there's economic activity in an economy and a growing money supply. But once again, not horrible. And then we get an economy that's growing in the first quarter, not as strong as we originally thought, but still 1.6%, not horrible. And then we get a durable goods orders report that's pretty damn good. So kind of a sign of an economy that is moving along. Not on fire, but not really too much of a problem yet. Then we got jobless claims, which of course we get every single week. Slight increase in initial claims, 215,000. That is the highest level in the past 5 weeks. Continuing claims also edged up to 1.79 million. That was just a 2,000 increase. Or I'm sorry, 20,000 increase from the previous week. And that's the highest level in 5 weeks. But remember that it's been in the last month or two. We were at what was it? 67-year low for initial claims, and continuing claims still are close to 2 or 3 year lows. So no weakness in the labor market. Another sign of just this economy that's moving along, just moving along. And then before we go on this rapid fire edition of Wilmington Mortgage, new home sales, which don't really impact mortgage rates, but it's always good to know what's going on in the national housing market. New home sales, this according to HUD and the Census Bureau, fell to 622,000. That was the second lowest pace in the last 17 months. Economists were only expecting a 0.4% decline. This was a 6. I think it was 6. Why don't I have the number in here? 6.2, I think, is what it was. Very bad of me not to put it in my notes. It was a mostly negative report across the country. Midwest fell 25% in April. Northeast was down almost 13%, and the South was down almost 10%. The West was the only bright spot, jumping 18.7%. But even with these steep declines, inventory levels rose modestly, 1.7% to 489,000 units. Now, the drop in sales, slight increase in inventory, did push up the month supply to 9.4, which was up 8% from March and was the second highest level in the past 10 months. But still, I mean, considering how big of a drop, I might have thought that might have gone to like 10 months supply, but it didn't. So, I mean, builders are clearly, higher rates. Their margins on the homes that they're building aren't what they were. A lot of them, built during COVID started when things were cheaper, and now you have elevated prices. And so they don't have the margin to offer as great of incentives as they were at one point with, just crazy buy downs and everything else. And I think that's clearly having an impact. Why you're seeing more of a slowdown, say, in new home sales than existing. I mean, they're both not doing amazing, but I think the reason why you're seeing maybe a bigger drop in new home sales is because those incentives are drying up. They can't offer them anymore. So that's it. That's all we got. So the basic takeaway is, the economy's just chugging along. It's doing what it's got to do. But nothing crazy. Nothing crazy. Nothing flashy. Nothing big going on. Just sort of economy chugging along. So on that note, we're going to move along as well. You guys enjoy your Friday. Enjoy your weekend. We'll be back here maybe Monday morning. Maybe. Trying some new things out. Maybe Monday. For another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. Buy real estate and wait.